For 30 years, if you were a global investor, the rule was simple. It was probably the most reliable rule out there. Just ignore Japan.
Don't touch it.
Don't touch it. It was the land of deflation, zero growth. It just made sense until now, because all the analysis we're looking at today suggests that rule isn't just bent, it's completely broken, and that 2026 is this historic pivot point.
It really is. And that's why we need to do this deep dive, because the old story, the one about, massive government debt and demographics, it's just not the whole picture anymore.
It's stale.
It's very stale. What we're seeing is something we're calling a nominal renaissance. It's a structural shift. So our mission today is to look past those old headlines and really get into the forces driving this.
Okay, let's do that. Because it's not just one thing, right? It's a whole bunch of forces hitting at once. We've got real inflation. We have wage growth hitting 30-year highs, a massive stimulus.
A $21.3 trillion stimulus package,
Yeah, and corporate reform that actually has teeth this time. So let's start at the very core of it all. The macroeconomic picture. The escape from deflation.
This is the absolute foundation. For years, any inflation Japan saw was, temporary. It was an oil price spike or a weak yen.
External noise.
Exactly. Just noise. Now it's demand pull. It's being driven from within by rising spending power. And crucially, it's being locked in by wage growth. We're seeing core CPI, that's the one without volatile food prices, settling right around that 2% target.
And 2% may not sound like a lot, but for a Japanese company's mindset, that is a seismic event.
It changes absolutely everything. For a generation, the only playbook was cut costs, hoard cash, avoid investment, because you couldn't raise prices.
Right.
Now they can anticipate higher revenues just from inflation. So the mindset is shifting from defense, from cost containment to offense, to capital expenditure, to growth.
And the thing that really shattered that old equilibrium that kept everyone stuck was wages.
The labor market.
That dynamic has completely flipped. You look at the 2025 Shunto the Spring wage talks, and the weighted average hike was an eye-popping 5.25%.
That's the highest figure in 3 decades. And if you take one number away from this whole discussion, it's that one.
And it's not a fluke.
No, not at all. We're expecting something similar for 2026 because the labor shortages are acute, they're structural. So for the first time in forever, labor has real bargaining power.
And that creates the virtuous cycle, right? Inflation leads to higher wage demands, and higher wages fuel more spending and more inflation.
It feeds on itself. That's the engine of the nominal renaissance.
So what does this mean for the economy as a whole? Real GDP, actual volume growth, is still pretty modest, maybe 0.7 to 0.9%.
Sure.
But nominal GDP, the size of the pie in yen, is projected to grow 3 to 3.5%. Why is that nominal figure so much more important here?
It's critical, especially for a country with a lot of debt. Nominal GDP is your total national income. Even if a company sells the same number of widgets, if prices are up 3%, its revenue is up 3%.
It's the money illusion.
It's the money illusion, and it's what pays down debt. If your income, your GDP, is growing at 3 or 4%, your big pile of debt gets smaller relative to your income every single year. It becomes more and more manageable.
Okay, so the economic engine is starting to turn. And it seems like the political will is there to pour fuel on it. Which brings us to Sanaenomics.
Right. And it's really important to distinguish this from the old Abenomics.
How so?
Abenomics was all about monetary policy, the central bank printing money. Sanaenomics, introduced by Prime Minister Takaichi in late 2025, is explicitly fiscal. It's about government spending, and it's driven by geopolitics.
And the spending is massive. That odd $21.3 trillion package, that's a huge injection of cash.
A huge injection, and it's built on 3 core pillars. The first one is what they call strategic autonomy.
Okay.
It's about accelerating defense spending to that 2% of GDP target, but with a focus on real counterstrike capability. It's a fundamental shift in security posture.
A more assertive stance. What's pillar number 2?
Technological sovereignty. This is the government directly funding and de-risking the semiconductor supply chain. You see it with the money going to Rapidus, the domestic chip champion, and the massive support for TSMC building fabs in Japan.
So they see chip manufacturing as a national security issue now.
They see it as a matter of survival. It's not just industrial policy anymore.
And the third pillar brings us right back to inflation.
Inflation mitigation, yes.
Yeah.
You can't engineer a reflationary boom if the public gets crushed by the cost of living.
Great, you'll get a backlash.
So you see direct cash transfers, like the or $20,000 per child payment and utility subsidies. It's a cushion to help households get through the transition until those higher wages really kick in.
Now, as soon as you say Japan and a 21 trillion yen stimulus, the alarm bells go off for a lot of people. The debt.
The headline fear, always.
The gross debt to GDP is around 230%, highest in the developed world. So the question is obvious. Isn't this a time bomb?
It's a right question to ask, but that gross number is, frankly, misleading. You have to look at the mitigants. First, and most important, is who owns the debt.
Okay.
Over 88% of Japanese government bonds, or JGBs, are held domestically by the Bank of Japan, by local banks, by insurers.
So it's not flighty foreign capital that can just pull out at the first sign of trouble?
Exactly. There's almost no risk of a classic creditors' revolt like you saw in Greece. These institutions are stable, long-term holders. They have to be.
And then there's the other part of the balance sheet. We always hear about the debt, but what about the assets?
That's the second key point. The government holds enormous financial assets.
Yeah.
So when you look at the net debt to GDP, which is a much more honest number, it drops to around 150 to 160%.
Like, it's still high, but it's suddenly in the same ballpark as other G7 countries.
It puts it in a manageable category, not a crisis category. And there's one more factor here keeping things stable, this great repatriation. As U.S. interest rates start to come down, the gap with Japan's rates narrows. So Japanese insurers who own trillions in U.S. treasuries are selling them and bringing that money home to buy higher-yielding JGBs.
So there's a huge natural domestic buyer for the debt.
The huge buyer, which puts a natural ceiling on how high borrowing costs can go. The Ministry of Finance is also helping by issuing more short-term bonds instead of the really long-term, more volatile ones.
It's a very managed system. And all this management of the debt allows the Bank of Japan to do what it hasn't done in decades: normalize policy.
Yes, the mission has changed. It's no longer about fighting deflation. It's about managing the transition back to normal. The policy rate hit 0.75% in December 2025.
And the forecast is for it to keep climbing to maybe 1.5% over the next couple of years.
A slow, steady, and predictable path. And this is what creates that golden scenario we talked about.
Right, through the shape of the yield curve. You called it a bear steepening. Can you break that down for us?
Sure. It just means that short-term interest rates are rising. But long-term rates, like the 10-year bond yield, are rising even faster. We're seeing that 10-year yield test the 2.0 to 2.5% level.
And that gap is what's golden for the banks.
It's a gold mine. Their business is borrowing short from depositors and lending long for mortgages and business loans. For decades, that spread was paper thin. Now, as the curve steepens, they can reprice their loans upwards much faster than they have to raise rates on savings accounts.
So their net interest margin, their core profitability, just explodes.
It expands dramatically. After decades of compression, it's a massive tailwind.
Okay, so we've got the macro, the politics, the debt is manageable, and the banks are set to boom. Let's move from the theory to the practice. Which specific sectors are set to benefit most?
Right, this is where the rubber meets the road. The analysis points to an overweight on a few key areas. First up, defense and aerospace.
This feels like a direct play on Sanaenomics.
It's the most direct play. The commitment to double defense spending creates a guaranteed revenue stream that's completely separate from the economic cycle. Plus, with relaxed export rules, these companies can now sell globally.
Okay, number two.
Semiconductors.
Yeah.
But not the companies designing the fanciest chips. We're talking about the picks and shovels.
The companies that make the super specialized manufacturing equipment, the testers, the coders.
Exactly. Japan has a stranglehold on that part of the market.
Yeah.
And with the global AI build-out, demand for that equipment is just soaring. The government subsidies just de-risk the whole thing.
Makes sense. Third.
Financials, the purest play on monetary normalization.
We just covered that. The steepening curve means bigger profits.
Bigger profits, and there's a bonus. All this corporate reform is forcing them to unwind old cross-shareholdings, freeing up capital that they're using for massive share buybacks.
And finally, a classic Japanese institution, the trading houses, the Sogo Shosha.
A unique model. They are a perfect vehicle for this environment. Their commodity businesses are a natural hedge against inflation.
So as prices for energy and metals go up, they benefit directly.
Correct. And their other businesses in things like retail and food provide stable earnings. It's why you see smart investors like Berkshire Hathaway continuously backing them.
And that point about share buybacks brings us to the quiet engine behind a lot of this. The corporate governance revolution. This isn't just a suggestion anymore.
No, this is the enfacement phase of the Tokyo Stock Exchange reforms. They are targeting any company with a price-to-book ratio, a PBR, below 1.
Let's just quickly explain that. A PBR below 1 means the market thinks your company is worth less than the value of all its assets, that you're actually destroying value.
You're destroying value.
Okay.
And the TSE is now saying, loud and clear, fix it. Present a plan to use your capital more efficiently, or you could be delisted.
The threat is real.
The threat is very real. And it's forcing this great unwind of old, unproductive cross-shareholdings. Trillions of yen in trapped capital is being unlocked and returned to shareholders through buybacks and dividends. It's a structural boost to returns.
Okay, so it's an incredibly powerful, coordinated story. But we have to be balanced. What could go wrong? What are the biggest risks that could derail this whole pivot?
You have to watch the external environment. First and foremost, an escalating U.S.-China trade war. Japan's big automakers have huge supply chains across Asia. New U.S. tariffs could hit their profits very, very hard.
And what about the currency itself? A weak yen has been helping exporters.
Right. So a sudden, sharp appreciation of the yen would be a problem. If it snaps back to, say, 120 to the dollar too quickly, that would squeeze exporter earnings and could stall the whole recovery. That's a real risk.
Any domestic risk?
The main one would be a fiscal misstep. If the Takaichi government gets reckless with spending, if it's not targeted at productive investment, that could spike bond yields in a bad way and force the Bank of Japan to intervene in a way it doesn't want to.
So to bring it all together, we have structural inflation, historic wage growth, a massive targeted stimulus, a manageable debt situation, a banking boom, key strategic sectors with tailwinds, and a governance revolution. It really does feel like a historic pivot.
It is. This isn't just a cyclical upswing. It's a coordinated multi-year shift. And the really interesting thing, I think, is how it contrasts with the rest of the world.
How so?
Well, you look at Europe, you look at other parts of the developed world struggling with stagnation. Japan is actively, aggressively engineering nominal growth through fiscal policy and corporate mandates. So the provocative thought I'd leave everyone with is this. Is Japan's playbook for escaping stagnation about to become the blueprint for everyone else?
A fascinating question to ponder as we watch this all unfold. We are not certified financial advisors, and this content is only for educational purposes. If you are considering making any investment decisions, please consult a certified financial advisor.